So a lot of our speakers have experience in multiple different industries, so any business you're in or any business you're starting, like I think they have enough information to cover all industries. So with that, we're going to introduce our next and last speaker before the lunch break. We're almost there. The next speaker is Babaian. He's the founding partner at Encore Law Group. His firm basically covers business, intellectual property law, merger acquisitions. I believe he works with even nonprofits. He's been a super lawyer for about 4 years, I believe, from 2015 to 2019. He's worked in many different industries. Please welcome Babaian.
All right, hello everyone. Good morning. Still morning. So, Babaian, my firm is Encore Law Group. I'm a business transactions attorney. I head the transactions department in my law firm, and I work with entrepreneurs and mature companies and serial entrepreneurs. So, by a show of hands, who wants to start a business? Okay. And by a show of hands, who already owns a business? Whose businesses are up to 10 employees? Okay, great. So now I have an idea of the audience, and I'm here today to address apparently the Armenian entrepreneurial spirit. And that's why we're all here today. It's a testament to, the culture and who we are and what we're doing in this incredible country. So with that, I'd like to begin. I'm going to be talking about, where do I point this? Anywhere?
Hit it down.
Okay. So I'll be talking about business formation issues. My topic is extremely broad. I'm going to be touching upon topics that other speakers have already spoken about or will be speaking about, but mine, when I go to those topics, it'll be very, very brief. But when you're forming a business, it's like laying the foundation of a house. It's really important to basically get it all right. And you're also working with a limited budget because it's a startup. So, with the constraints of the limited budget, you really need to get it right because if the foundation isn't correct, then building the house and fixing it later on when there's a problem is going to be more problematic. So, I know Vahan is going to be speaking about the taxation issues right after lunch. So I'm not going to focus too much about them. In this slide, it's America, we have choices. Sole proprietorship is not a good choice. It leaves you naked, essentially, because it's not an entity form. It's just, you putting out your lemonade stand on the street and selling lemonade. And that's just a sole proprietorship. I'll actually skip to partnership first. A partnership is any two or more people on a common business enterprise. And there's two kinds of partnerships. The general partnership, wherein the two or more partners are liable essentially for all of the obligations of the partnership. And then there's a limited partnership, which tweaks that by introducing the concept of at least one general partner, and maybe multiple limited partners. That entity type is still used, but not as much. The entity types that are the three kind of big ones that are currently used in most businesses are LLC, C Corp, and S Corp. And so first with an LLC. An LLC was started in the 70s in Wisconsin. So Wisconsin is actually a very proactive state when it comes to corporate matters. And there are LLC's owners are called members. And the management of the LLC, as in, for example, the board of directors, those would be called either the managers or the managing members. And typically, it's taxed as a partnership, meaning it's a single layer of tax. It's pass-through taxation to whoever the owners are. And one thing that's really important to keep in mind is that the taxation, the allocation of the net profits and net losses is different from the distribution. So, a bad situation, for example, would be one partner getting the cash, one member of the LLC getting the cash distributions, but for whatever reason, the allocation of the profits being made to the other member, because what you get taxed on is your allocation and not your distribution of actual cash. But again, I'm going to leave that to Vahan to talk about later on. The next entity type is a corporation. So when all corporations are formed, they automatically are C corporations. In a C corporation, there's double taxation. The income that goes into the corporation gets taxed, and then if and when a distribution is made or a dividend is made to the shareholders, they get taxed. In order to be taxed as an S corporation, which is like partnership taxation, a single level of taxation, you have to do an S election. And once you do that, then you have a single level, you get rid of that double layer of taxation. But with respect to both kinds of entities, they have, essentially, I like to think of it as 4 types of people in corporations, and this is true for both C Corps and S Corps. So the first kind of party in the corporation is the owner, and those are the shareholders. And the second kind is the board of directors, the third kind is the officers, and the fourth is employees. So first kind, shareholders, they're the owners, and what they do, their kind of most important job on an annual basis is to elect the directors. There's other things that they do, there's other really high, very high level things, like if there's a merger or sale of a business, that they would vote on, but on an annual basis they have to, the one thing they have to do is vote for directors. So they have a lot of control with that. The directors are like the brains of the organization. They're the ones who set the policies, who evaluate the budget, set the budget, determine the direction of the company, and so forth. And they also, their important function is to appoint the officers. And the officers are typically the CEO, CFO, and secretary. And those are like the arms and legs of the corporation. The CEO is the general manager. They do the daily management of the business. And then, of course, there's the employees, as I mentioned. There's many other kinds of entities, actually. 2 more are public benefit corporation, which we have in California. This was a way to address the desire for some people who wanted to form a corporation, but they didn't want to necessarily be required to distribute every single penny of profit to the shareholders. They wanted to keep in mind the environment or the whales or impoverished, communities or what have you. But I've worked with them. I don't recommend them because it's like you're trying to do something that is in the nature of public charitable work, but you're going to be taxed as a C corporation. So you're going to get double taxation. Until the Internal Revenue Code catches up with what the states are doing in terms of public benefit corporations, I don't recommend them. It's actually costs more to maintain it on an annual basis. And then of course there's nonprofit tax-exempt organizations, and I'm happy to talk about those. I do have a nonprofit practice as well. Okay, major considerations. Major considerations in terms of what entity to choose, what choice of entity to make. So the source of financing is incredibly important. If you're getting venture capital financing, then you are probably only looking at doing a Delaware C corporation, although sometimes they're getting a little bit softer and they're allowing Delaware LLCs as well. If you're doing partnership with high net worth individuals, chances are you're doing an LLC. So it really depends on, or if you're doing self-financing and there's only like 1 or 2 of you, you're probably doing an S Corp. Let's see, corporate tax treatment, again, I touched upon double taxation and S Corp pass-through taxation as well. And then, I touched upon LLC tax treatment, which LLCs actually can be taxed, as I mentioned, as a partnership, or you can do an S election for an LLC. And the times when I do an S election for an LLC is when I have, let's say 1 person or a couple of people who want to form the LLC, and we want to, LLCs are much easier to maintain on an annual basis because once you enter into the operating agreement, you don't have to annually elect the officers and the directors. Well, the directors annually, the officers you don't have to do it annually. So what we do is we form the LLC and then we do an S election. And so you're kind of getting the best of both worlds, the ease of administration of an LLC along with the benefits of S-Corp taxation, which again, Vahan will talk about. I'm putting a lot of pressure on Vahan Babaian, who's sitting in the corner. Another major consideration in terms of what kind of entity you're going to have is the question of, is it a cow or a pig? So what I mean by that is it a cow that you are going to keep for the long haul and just milk? Or is it a pig that you're going to grow, and then slaughter? So that's another question, and that will impact what entity type you choose, because, for example, if let's say, you want to avoid double taxation if you're going to be a cow, because as a cow, you're going to keep it year after year. But as a pig, you don't care, because, if you're not taking money out and you just want to grow the company, and then at the very end you want to sell it, the double taxation is not going to be an issue. So, relationship of the partners, I already touched upon C corporations and officers and directors and shareholders, how the shareholders elect the directors on an annual basis, and then the officers serve at the pleasure of the board. And LLCs have managers and members. And one thing important to note about S corporations is that you must be, and so this is true of an LLC that is elected as an S corp as well. You must be a U.S. or territorial corporation. Only individuals, like people, can be shareholders, and some trusts. So there's some kinds of trusts that are okay. No more than 100 shareholders, and only citizens or U.S. residents can be shareholders. So if you're getting investments from abroad, you can't be an S corporation. And one class of stock, meaning every single share of stock has to have the same economic rights as every other share of stock. However, when it comes to voting, you can't have voting and non-voting stock. So the next one is different kinds of financing. So obviously self-funded, that's nice if that can happen. Next one is high net worth individuals. And again, as I mentioned, with those, I think an LLC is a great format to use when you're getting financing. Even when you're getting financing from people who are, like their day job is a venture capital, a partner of a venture capital firm, but they're investing not through their VC firm. They're investing outside of their VC firm. Loans and credit cards and SBA, which Sean mentioned, is a partnership between the government and the banks. And then there's other services like Blue Line, On Deck, and many others that, for example, Blue Line recently just closed a preferred stock financing for itself of $100 million. So it has $100 million that it is able to loan businesses. And for example, on a credit line, they will loan up to $250,000, and you can get it approved in as little as 5 minutes. I mean, it's really amazing, and it's a really incredible source, either for cash flow purposes or for factoring purposes if you're a fashion company, for example. And then, of course, there's sweat equity, and I'll talk a little bit more about sweat equity and how to compensate people for sweat equity in a minute. Next one. Okay. Are you the next Mia Yajur? So, are you? It would be good to know, because then we'll invest in you. But the different kinds of investments that you typically see when it comes to equity or something that's going to convert into equity is convertible promissory note. That's the most traditional kind of financing for a very early startup. So I'm not talking about the angel investing, which is some people just giving you money and getting common stock usually. I'm talking about when you're raising anywhere maybe between $500,000 and maybe $1.5 million. Although I've also done convertible note financings that are much more than that because it was a business that required much more financing. The reason you do a convertible promissory note, okay, first of all, it's a loan. As a loan, it has an interest rate. It has maturity, just like a loan, because it is a loan. And but what it does is it converts. either optionally at the option of the company or at the option of the note holder, or automatically depending on either the passage of time or more likely if there's the next equity financing, which is when you do a preferred stock financing usually of a certain, like let's say at least $1 million, and then it'll automatically convert into a preferred stock, usually at a discount, and the discount is usually anywhere between 10 and 20%. But the reason you do a convertible note is because you don't want to determine the valuation of your business yet. Because if right now all you need is $1 million and you're a new business, and let's say you come up with a valuation of $2 million for your business, you don't want to give away 50% of your company. So you'll do a convertible note and it'll convert later on when you do the priced financing for the preferred stock. A safe is the same thing. Safes were kind of invented by Y Combinator in Silicon Valley, and they're the same thing as a convertible note, except that it's not a loan. It never gets paid back. They basically said this is nonsensical because investors who get promissory notes, if they're if they know what they're doing, they're never really expecting to get their repaid under the loan along with an interest rate. That's not why they're doing a note. They're doing a note because they eventually want the preferred stock, and they want the miayachur in the future. And then finally, there's the preferred stock, which is the actual equity. Now we're talking about equity. So that's the actual equity, and that's senior to common stock. And there's many different ways it could be senior: preferred dividend, preferred liquidation rights, voting rights, and so forth. I'm doing this very fast because I have a few more slides. Managing expectations. This also helps determine what kind of entity you're going to be forming. So in the realm of managing expectations, these are probably some of the top, hopefully the top documents that govern your relationships. So an LLC operating agreement for limited liability companies, shareholders agreement for corporations, whether it's an S Corp or a C Corp, along with the bylaws, I should mention. Equity grants, so that's a way to control the relationship with your employees and service providers with the vesting schedule, because you should, actually I'll get into that in the next slide. But then job descriptions, and it's tricky when it comes to, especially in California, which is a state that really, after the Dynamex case in May of 2018, it's really hard to have independent contractors, but when it comes to startups, in the first year they kind of let it slide. So you can actually have people working on a 1099 basis, but then by the second year, you really should convert them into employees. But these are some documents that you need in the advisory board agreement: IP assignment, confidentiality, arbitration agreement. I would never, for example, personally serve on a board of a nonprofit or a for-profit if I didn't have, I was talking about indemnification agreement. That's where I get sued because of something relating to the company, and then I get the company to pay for those expenses. And that master services agreement is with your clients. So, yeah, here we are. You get equity, everybody gets equity. So talk about vesting. Vesting is when you're granting the equity to your service providers, whether they're employees, advisors, or board members, or contractors, or even vendors, suppliers. What you really should do is have a vesting schedule, because you hire somebody and you think that person's going to work out great, but then they don't, and then they go off the deep end, and you never see them again. You need a way to retract the equity that you give to them, and that's how you do it. And the vesting schedule differs depending on who. Like advisors, usually it's like a 12-month, 24 months vesting schedule. Employees are usually 4 years, 5 years. And how much to give. Co-founders, it's like the Wild West, it's whatever kind of makes sense. Employees, it depends on the seniority of the employee. The C-suite type people, they would usually get maybe like 1 or 2%, maybe more. If it's kind of a star person. If it's a lower level employee, like a rank and file employee, we're talking about under 1%, maybe, for sure even under 0.5%. And advisors, it depends. I mean, if you have, you know, somebody really connected and who's going to really be able to like reach out and get investors for you and do things for you, you give them more. But usually for advisors, it's, I would say it's under 1% or even under 0.5% as well. Employee grants, early on you give restricted stock because you can set the valuation of the company at like 0.0001 cents per share. But once the company has valuation, restricted stock means that it's restricted by their ability or inability not to transfer the shares. And it's also subject to a vesting schedule. Once there is actual valuation on the company, like $1 per share or $10 per share, then you would transition to stock options. And that's basically a right to purchase the shares at the stock option price. So they don't have to actually pay it at grant. Whereas with a restricted stock, they do actually have to pay it. And another tool that I use a lot is shadow stock or phantom stock, which actually is not equity at all. It's, it tracks the value of the equity, and there's many, many ways to do it because it's a contractual relationship at the end of the day. And, but I like it because I always advise my clients to not jump the gun and give away too much equity. And then profits interest, these are, you know, I'm going to skip these because I can spend an hour talking about these topics. The profits interest versus membership interest, that has to do with LLCs. And profit participation is a fancy way of just saying a cash bonus plan. Privacy alert. So correct me if I'm wrong, but is there a word in Armenian for privacy? I don't think so. Is there? Bunch of Armenians here. Nobody's helping out. Minagutun isn't. Kopnik, you know, it isn't. It's, you know, I don't know. We just don't have that concept in our culture, I don't think, based on my experience with my family. But California enacted the California Consumer Privacy Act, which is going into effect on January 1. We're the first state in the country to enact this law, but the first state to have this kind of law actually already in effect is Nevada. And what this is on your website, you have to have a privacy policy that tells the user of your website what information you're collecting and how you're managing that information, what you're doing with it, and what their rights are with respect to that information. And it's really important, if any of you have any websites, you have to comply with this by January 1. It's super important. And you need the back end with your web person to make sure that you're able to do what the law requires you to do. Yeah, I mentioned Nevada beat us to it. A record retention policy is really important in your company so that you can hold on to documents for, let's say, 5 years and then throw them away without having liability, if that's your policy. And another topic that's really important, recently a client of ours got hit with this, and between legal fees and paying the plaintiff, they were out of pocket $20,000. So the ADA compliance is really important. So if you have a physical presence, your website actually has to be ADA compliant. ADA is the Americans with Disabilities Act, which usually you think about ramps and wheelchair accessible, but for a website, it's accessible for the visually impaired and for the hearing impaired. So that's something that's really important, and it's actually not difficult to get your website to be compliant with that. And if you need referrals to web people who can do that for you economically, I can let you know. Okay, people in your corner, I think all of these people are represented, or most of them are represented here. Attorney, CPA, banker, insurance agent. In the realm of insurance agent, it would be malpractice of me not to advise you to get EPLI, which is Employment Practices Liability Insurance. In California, it's just mandatory basically, because otherwise you're going to be paying your own legal fees and even damages if you don't have it when that employee inevitably sues you, because it happens to every company. And EPLI, Employment Practices Liability Insurance. And if it's kind of like if you don't listen to anything I say today, that's the most important thing. Yeah. And what else? And if you talk to Sarah over there, she's an insurance agent, Sarah Sitak, and she helps me out with all my insurance needs. Another one that's really important is business interruption insurance. And that's when there's a flood and your equipment is destroyed and your business stops for 3 months. The insurance company will actually pay you for the profits that you lost in those 3 months. Okay. And that's me. So my topic is extremely broad and it touches upon a lot of different things. And I'm happy to, talk with you guys now or in the future or, so any questions?
Is there any advantage of corporation C over corporation S?
Any advantage over a C Corp or over an S Corp? Well, certainly. I mean, if you're getting, Delaware venture capital financing, you have to do it, and that's an advantage there. I think your question might have to do with liability. From a liability point of view, an LLC, a C Corp, and an S Corp, they provide the same kind of liability against plaintiffs and lawsuits. It's just a tax issue that we're talking about. That's the real difference between it.
It's better to have S than C.
If for tax purposes, if you can do it, yes.
We have a question here.
So, will you elaborate more about why sole proprietorship is not a good idea? And then my second question is, you said the public, after S Corp, the public option is not a good idea. Also, were you talking about the B Corp?
Mm-hmm.
And if it's yes, will you elaborate more? Why?
Yeah, so a sole proprietorship is basically, like I said, it's just you doing business. You don't, there's no entity, which means that when you do your taxes, the business tax deductions have to go on your personal tax return. That automatically puts you at a higher level, a higher risk of being audited by the IRS, because the IRS is always suspicious when people are filing personal tax returns with a lot of business deductions on it. So that's one reason. I mean, just that reason alone is good to form an LLC. And by the way, I also don't recommend forming a single-member LLC, because single-member LLCs, the entity is disregarded for tax purposes, and you run into the same issue putting the tax deductions on your personal returns. So with an LLC, I always do at least 2 members. And then I put things in the operating agreement to make sure that the main member can get rid of the other member really easily. But with a sole proprietorship, it's not an entity, which means you can't sell it. You can sell the assets, but it's not something that you can bequeath, like in a will. And your second question had to do with B Corps, the public benefit corp. It's the same thing. Every state has a different name for it, a little bit. And it's a great idea, because it came from when for example, Ben and Jerry's, this was the famous case. Ben and Jerry's in Vermont, they were publicly traded, they were a corporation, and every year they would get some of their profits and give it to, the forests and the whales and saving things, which is wonderful. But once they became a publicly traded corporation, all of a sudden there was, real pressure upon them to enhance shareholder profit by distributing all the profit to their shareholders. And they're like, wait a minute, that's not our company ethics, that's not our value. And so there were lawsuits and things like that. So then they, other examples like that, Patagonia, and so they came up with this concept of a B Corp, or a public benefit corporation. And with that entity, you are allowed to think about other constituencies, like the whales and the dolphins and poor people and so forth. So you don't have to distribute all the profits to your shareholders, in other words. But unfortunately, the taxation doesn't match that. So if you really want to do something that is charitable, I would say do a nonprofit organization, which is 501c3 tax deductible, or have just a S corporation or an LLC that maybe you can have an understanding with your partner, with your shareholders. Oh, okay. Looks like that's it, but I'm happy to answer any questions. Thank you.